Welcome to Woods of Stardon. This is CH. I will be covering the Allianz Income and Growth Fund in this video, which is a refreshed version of the video I did in early 2025. This is part of my Absolutely Biased Comments or ABCs series, whereby the aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. Allianz Global Investors, also commonly referred to as AllianzGI or AGI, is the original asset management arm of Allianz since 1974 and was probably established as a global integrated investment firm in 2012. Allianz is the world's largest insurance company and Europe's largest financial services company, so there is definitely a high degree of business stability for AllianzGI. Another popular fund provider, PIMCO, is actually also a subsidiary of Allianz, though both asset management brands run independently. AllianzGI has over 700 investment professionals managing about 600 billion euro of assets under management. Assets are quite evenly distributed across equities, fixed income, multi-asset, and private markets solutions. Considering insurance company-owned asset management businesses tend to be fixed income heavy, AllianzGI is rather well diversified for its exposures. The fund doesn't follow a single investment philosophy or approach, but instead is open to different active investment strategies, which is probably an extension of its history as a conglomerate of boutique investment teams. AllianzGI was involved in a legal case relating to one of its US products back in 2022, and the outcome of that was that the firm transferred majority of its US onshore funds and US-based managers to Voya Investment Management and took a 24% stake in Voya. For strategies that also has international versions, the managers who were transferred to Voya IM would continue to manage the funds, even though the international funds remain under the Allianz Global Investors business. The Allianz Income and Growth Fund is one of such funds that has this odd arrangement. The Allianz Income and Growth Fund is a sub-fund under the Allianz Global Investors Fund or Allianz GIF fund family. Allianz GIF is set up as a Luxembourg SICAV company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Allianz Income and Growth Fund lists 4 managers in the fund webpage, with a fine print that states these managers were transferred to Voya Investment Management in 2022, which is as I mentioned earlier. Given this transfer, AllianzGI actually doesn't provide any further details on these managers in its website, which is not good for investors who want to understand these managers more. Morningstar shows the fund should have 5 managers instead, with Justin Cass, David Oberto, and Michael Yee since the transfer in 2022 till now. Ethan Turner joined in 2023, while Matthew Exline joined in late 2025. To find out more about these managers, we actually have to visit the Voya Investment Management website, where we can find a global version of the income and growth strategy that is managed by the same team. Scrolling down, we can find the list of the 5 managers in their team with their photos and links to their respective bios. Again, I find the lack of this manager information in the AllianzGI website really inconvenient for investors. Let's take a quick browse at the manager bios. Justin is the CIO and co-head of the income and growth team. He also appears to be the key person responsible for the convertible bond sleeve with his past experience. Michael is a lead portfolio manager in the team. He has the longest work experience with Allianz than Voya and appears to be the key person responsible for the equities sleeve with his past experience on US large cap markets. David is also a lead portfolio manager in the team. He appears to be the key person responsible for the high-yield bond sleeve, given his past experience in US high-yield bonds and credit default swaps. Ethan is the more junior among the four, and he appears to have been promoted to lead portfolio manager in recent months, as he did not have this title when I covered the fund about a year ago. Matthew is the newest hire in the team, although he previously worked in Allianz as well. His experience in small caps equities looks to be complementary to the team and suggests the fund strategy may increase exposures in this market segment. The Allianz Income and Growth Fund provides a short investment objective in its fund webpage and fact sheet that indicates the fund has a dual objective to achieve growth and income, although it is not clear here whether one has a higher priority over another. It is also mentioned this is a US-focused multi-asset strategy investing into both equities and bonds. The fund webpage also has an opportunities section that provides more information. Here, it becomes clearer that the fund invests specifically in US equities and particularly adding on call options to those equity exposures, US high-yield bonds and US convertible bonds. The fund comes with quite a number of sales materials, one of which is a sales leaflet document that further states that the asset allocation of the fund strategy is a fixed 1/3 US equities, 1/3 US high-yield bonds, and 1/3 US convertible bonds. From here, it becomes clear that the investment objective suggests this is a multi-asset portfolio, but it actually has a fixed asset allocation model and invests only in specific asset classes exposures. So it is less flexible and diversified compared to some of the broader multi-asset funds in the market. Investors will not find, for example, government bonds and investment-grade corporate bonds in this fund. The sales leaflet also clearly states the priorities of the objectives, whereby generating and providing income is the main objective, while growth is only a secondary and a potential objective. Investors should therefore set the expectations accordingly when considering this fund. The sales leaflet further stresses on income generation by elaborating on different potential sources of income, whereby capital gains on all three asset classes are also considered as income sources. While there are three asset classes in the fund strategy, it is important to understand that these three asset classes are pretty highly correlated with each other. Using common ETFs as examples, US equities have a 0.81 correlation with US high yield and 0.80 correlation with US convertible bonds. This means they tend to move in the same directions often, resulting in rather weak risk diversification benefits. Another way to see this is that the fund strategy is essentially a toned-down US equity solution with lower return expectations in exchange for lower volatility by swapping 2/3 of the equity exposure with high-yield bonds and convertible bonds. Allianz GI is not great when it comes to fund prospectus contents. The prospectus basically provides the same brief investment objective statement and a list of investment restrictions, with no mention at all on the investment process of the fund. While it says here that the fund can invest max 70% in any of the three asset classes within the strategy, we already found out earlier from the sales leaflet that the fund actually runs a fixed allocation of 1/3 into each of these three asset classes. The max 30% allowed for emerging markets is irrelevant here, as this is a fund with pure US exposure. The max 20% non-US dollar currency exposure is also not really relevant, as there would be little reason for the fund to find a non-US dollar exposure. Max 25% in money market equivalents might be a flexibility that can be used during market volatility spikes, although I haven't really seen it used in the fund before, and the only money market exposures are meant for transaction liquidity purposes. The fund doesn't have a defined benchmark, which is not ideal as benchmarks can be used by investors to better assess the fund's historical performance and give guidance to future performance expectations. We can, however, easily find ETFs representing the three asset class exposures and compare them with the fund, which we will do later. The Allianz Income and Growth Fund was incepted in 2011, giving it about 15 years of track record now. Fund AUM is at a very respectable 56 billion US dollars, as this has been a very popular investment product in the retail market over the years. The fund has about 5% in cash equivalents for liquidity purposes, and the rest of the portfolio is evenly split into US equities, US high-yield bonds, and US convertible bonds, as per the investment strategy covered earlier. The fund has over 90% allocation to US by country. There are very small exposures in various other countries that are presumably stocks and bonds listed in US by non-US companies, which the fund should also be able to invest in. I can't verify the details though, because the fund doesn't provide a full holdings list. Sector breakdown is a bit more mixed. While the fund is expected to have mainly large cap equities that are expected to have significant technology exposures due to market cap weighting, high-yield bonds tend to have higher coverage in consumer and energy sectors, so the resulting sector allocation in the fund portfolio is more mixed. Given the fund strategy also stated that the equity exposures have covered call strategies, it also means that those equities that can price attractive covered call options are probably prioritized as well, contributing to the shifts in the sector allocation. Top 10 holdings is provided, although it is not too useful as it combines equities and bonds together, so we can only see the usual mega cap tech names and a handful of bonds. The fund does have a decently large number of holdings, with 155 high-yield bonds, 118 convertible bonds, 91 equities and related positions, and 17 others that might be money market instruments or derivatives for portfolio hedging purposes. The fund also provides some additional portfolio statistics. Here, we can see the convertible bonds in the portfolio are mostly investment-grade credit rating that helps to offset the credit risk coming from the high-yield bond exposures. That being said, convertible bonds are not the same as typical investment-grade corporate bonds, and they have a much higher correlation to equities, as mentioned earlier. We can also see that while the average coupon yield for high-yield bonds is decently high at 6.9%, the convertible bonds coupon yield and equities dividend yields in the portfolio are really low, so they are not helping much in the contribution to the income generation of the fund. The low equities dividend yield also suggests that the fund mainly invests in high-growth, low-dividend stocks, or sacrifices dividend for covered call option premiums for its equity exposures. This also means that in order for the fund to generate a decently high income payout as part of its intended objective, a significant portion of this income would have to come from capital gains and covered call option premiums. This will potentially have an impact to long-term capital growth on the investment, which we will explore later. Let's get a bit more portfolio information from Morningstar. Here, we can see that the equity exposure is very large cap focused, with a slight tilt towards growth style. The market cap breakdown does show a bit of exposures in mid and small caps though, and I think there is a possibility for this to increase with the addition of Matthew in the manager team, who is a small caps expert. Bonds data in Morningstar is less useful, as it seems that most of the convertible bond exposures are classified as not rated, so I am not sure how accurate the statistics are. For a popular fund with decently large AUM and decently long track record, the Allianz Income and Growth Fund comes with a rather long list of share classes that can be quite confusing for investors. The A share class would be the normal retail share class that most investors will see in the distributors list. Besides US dollars and Sing dollars, the fund covers a wide variety of currency classes to cater for investors' requirements globally. Aside from base currency US dollars, most of the other currency classes are currency hedged, as denoted by a H or H2. Given the fund has income generation as the primary objective, most share classes available are distributing share classes. The M denotes monthly distribution frequency. The fund has accumulation version for US dollars but not for Sing dollars. So Sing dollar investors who do not need the income payout will need to opt for distribution reinvestment when placing order with the banks or distributors. We will go through the different versions of distributing share classes in a while. The retail AA share classes have a management fee of 1.5%. Adding other expenses gives a total expense ratio or TER of 1.65%. Up to 50% of the management fee can be paid by AllianzGI to distributors as trailer fees. Investors looking for cheaper share classes can try to find distributors that offer I, P, or R share classes, assuming the minimum investment requirements are met or waived. Distributors are allowed to charge up to 5% subscription fees for the fund, although I think anything more than 2% for mutual funds is excessive. Let's go through next the rather complicated distribution share classes of the Allianz Income and Growth Fund. The fund fact sheets do provide the latest distribution amount and annualized distribution yield of the different share classes, but do not provide distribution history. The fund webpage does have the full distribution history though, and comes with date filters and allows investors to download the data into an Excel file, which is good. However, I think the best distribution information is found in a separate fund literature webpage, where it has a fund dividend composition PDF that can be downloaded. The PDF contains the past 12 months distribution data of each share class of each fund, so it is a pretty long document. What is good about this PDF is that it contains the historical breakdown of the distribution from income and capital, as well as the underlying portfolio yield for reference. These data are not found in the fund-specific webpage and documents. From the data, we can see that the fund adopts a smoothened payout approach with fixed distribution amounts through the months, and this is applicable for all the A, US dollar, and Sing dollar share classes. This approach provides income stability and certainty to investors, and the distribution amounts is typically reviewed on a quarterly basis. Given the amount is fixed while the fund NAV fluctuates over time, this means that the distribution yield percentage will also fluctuate slightly every month. So we can refer to the fund webpage or fact sheet for the latest annualized yield percentage. What is important for investors to note here is that the distribution yield of the share classes are way higher than the underlying portfolio yield, which means a significant portion of the distribution yield must have been generated through the capital gains and the equity call option premiums, as we went through earlier. This is evidenced by the data here that shows a significant portion of the distributions are paid out of capital. This works in a bullish market environment, where there is sustainable capital growth. However, things will become problematic in a bearish market environment where there is capital loss due to market movements, and at the same time, the fund needs to further reduce the remaining capital to convert into distributions in order to maintain the income objective. The fund will likely reduce the distribution yields in such environments, but the negative impact to the investment capital would be there. Let's come back to the different share classes of the fund. From the fund fact sheets, here are the current annualized distribution yields, where we can see some hovering at around the 4% levels, while the rest slightly above the 8% levels. To explain these differences, we will try to understand the acronyms in the share classes. Besides the A that represents retail share class and M that represents monthly distribution frequency, we can see an I in all the Sing dollar share classes. The I refers to IRD neutral policy as per the prospectus, which basically means the currency hedging costs are factored into the NAV instead of distribution. Therefore, the AMG2 US dollar share class and the AMG I2 Sing Dollar Hedge share class have about the same distribution yield. Now the G normally refers to gross distribution policy, which means fees and expenses are deducted from NAV instead of distribution. This, however, looks confusing because the share classes with G clearly have lower distribution yields than those without G, when it should be the other way around. So what's going on here? The answer is actually found in the AllianzGI Hong Kong website that has an additional explanation document. In the document, it clarifies that specifically for Allianz Income and Growth Fund, the AMG share classes are designed to have lower distributions that is not supposed to obtain income from capital gains, while the AM share classes are the higher distributions, where income can come from capital gains as well. This doesn't seem to be mentioned anywhere else, and therefore it is really confusing without a proper explanation like this document. The same Hong Kong document also mentions that the numbers 2 and 3 are used to refer to share classes with different characteristics, although I can't find any information or documents from AllianzGI that further explains them. As you can see, providing better clarification on these share class definitions is definitely an area that AllianzGI needs to improve on. Investors who are holding the AMI3 and AMGI23 Sing Dollar share classes should also take note that this will change in October 2025. Besides getting a rename, these share classes also move the currency hedging cost factor from distribution to NAV. As a result, the distribution yields have increased. There is no visible difference between the AMI and AMI3 share classes, or the AMGI2 and AMGI23 share classes. So I suspect these similar share classes will merge together in the future to further simplify the share class list. 8% is a very high number for distribution yields, and investors do need to put this in context with the overall total return of the fund. Assuming the higher distribution share class has been maintaining 8% in the past 5 years, this would mean that after the distributions, the net investment as expressed by the NAV went down about minus 3.2% each year. In a good year like 2023, the net investment went up 9.3%, while in a bad year like 2022, the net investment went down minus 27.7%. Investors who prefer to receive less income and have better long-term compounding growth in the investment should go for the 4% distribution share classes or even the accumulation share classes. Here is the Morningstar chart comparing NAV versus total return since inception for the AM US dollar share class that currently has about 8% distribution yield. As seen, the NAV has been basically kept flat through the years, with all returns paid out as distributions. Investors therefore should expect only high income, but not growth, for the higher distributing share classes. We briefly looked at the performance data of the Allianz Income and Growth Fund just now, and can see that the fund has about 8% per annum return since inception. However, the fund has no defined benchmark for investors to compare against. So purely on these numbers, we do not know whether the fund is doing good or bad. Fortunately, the fund runs a fixed allocation strategy and invests in asset classes that can be easily represented by ETFs. Here is a 10-year Morningstar chart for the fund compared with SPY, HYG, and ICVT ETFs representing US equities, US high-yield bonds, and US convertible bonds respectively. From the chart, we can see that high-yield bonds have the lowest return and volatility. Equities have way higher returns and volatility, and convertible bonds have decently high returns with sometimes uncorrelated volatility for this period of more than a decade. It is also interesting to calculate that if an investor had done the same fixed allocations into the 3 ETFs since the start of this time period, he would have achieved a much better return than the fund. In fact, As per this chart, the fund has underperformed both SPY and ICVT ETFs by a wide gap. The underperformance can be observed even if we shorten the time period to 1 year as seen in this chart. So this is a consistent problem. This is also on total return basis, so whether the fund has a high or low distribution yield is not the concern here. In this case, what are the possible reasons for this relative underperformance of the fund? I think the main issue here is the covered call strategy on the equity exposures. As explained in the fund booklet, covered call strategies work better in a flat or bear market, but not in a bull market, as the covered call exchanges equity upside potential for income premium. As far as I can see, the US equity markets have been in a strong bull run for the past decade or so. The fund is therefore missing out a lot of equity upside through the years. There is also possibly poor security selection in the portfolio because the fund performance seems quite far from both SPY and ICVT's ETFs. Although as investors, we wouldn't know because there is not enough details provided by the fund for us to review the positions. Last but not least, the relatively high TER for the retail share class of the fund compared to the ETFs also eat up some of the return potentials. As such, this fund is actually not a good solution to capture long-term equity returns or equity participation, despite what some of its marketing materials mention. Looking at this long-term chart, we can see that investors can actually get better returns with just 50% of investments into SPY ETF and remaining in cash than 100% into the fund. The fund is also not a good solution for investors looking for a well-diversified US multi-asset exposure, because as mentioned earlier, the correlations among the three asset classes are high. As the US markets are highly efficient and have a wide variety of investment products, it is very easy for investors to create a customized multi-asset exposure that comes with better risk diversification or with broader asset class exposures. For example, investors can combine the SPY ETF with PIMCO GIS Income Fund, both highly popular products, with equity to bond allocation of their preference to get a similar risk and return profile as the fund. Investors looking for a single product instead also have a wide variety of choices in the market. Here are a few that I have covered in the past, and we can see the Allianz Income and Growth Fund is neither the best nor the worst performer among these funds. Therefore, I think the more appropriate positioning for this fund is actually a US High Yield Enhanced or US High Yield Plus solution, whereby the fund can offer investors with a performance behavior that is highly correlated to US high yield, but provides a higher return and volatility profile. The high distribution yield characteristic of the fund also resonates well with high yield investors. Last but not least, here is a quick look at the performance differences between the US dollar share class and the Sing dollar hedge share class. We can see the share classes historically have been quite similar, and it is only the past 2 years or so that the gap has widened, because the currency hedging costs have increased significantly. This is not a fund-specific problem though, as this has been the case across all funds with currency hedge share classes. With that, let's summarize our findings. Allianz Global Investors is the asset management arm of Allianz, the largest insurance company globally. It manages about €600 billion worth of assets. The fund managers were relocated to Voya Investment Management that is partly owned by Allianz. The managers' information and bios are however only available at the Voya website, which is difficult for interested investors to find. The fund strategy is not complex, and is basically a fixed allocation of 1/3 US equities, 1/3 US high yield, and 1/3 US convertibles. While the fund is considered a multi-asset solution, the high correlation among the three asset classes means it is not great when it comes to risk diversification. The fund doesn't have a defined benchmark, which would have been easy to create with a fixed allocation of 3 indices representing the asset classes. The lack of benchmark makes it difficult for investors to understand whether the fund is performing good or bad. The fund clearly has a high focus on income generation and states that the coupon yield, dividend yield, covered call premiums, and capital growth can all be used as sources of income. On the flip side, capital growth seems to be a low and optional priority, with the covered call strategy on equities missing out too much equity upside, and most, if not all, of the returns are converted to income distribution. The fund used to have more share classes with different distribution yields, but seems to have simplified them to just 2. The usual high 8% distribution yield share class that converts all the returns to income payouts, and the lower 4% distribution yield share class that retains capital growth in the NAV. allianzgi is, however, still quite bad when it comes to providing explanations on the different types of share classes, as covered in the video earlier. Given the focus on income, the resulting total return of the fund has been underwhelming. Investing in the fixed allocation of ETFs representing the 3 asset classes would have delivered a better performance. In conclusion, the Allianz Income and Growth Fund is not a great product as a US multi-asset solution, as there is no flexibility in the allocation, and the high correlation among the 3 asset classes means risk diversification is poor. The return and risk profile and the focus on income payout of the fund makes it more appropriate to be positioned as a US high yield enhanced or US high yield plus solution. This concludes my absolutely biased comments on the Allianz Income and Growth Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.